What if I told you there's a massive, scary financial disaster looming? Billionaire investor Warren Buffett is sounding the alarm. Imagine a colossal $1.4 trillion debt-fueled storm about to hit the U.S. real estate market. It's already causing trouble, and we're in the thick of it right now. But hang on tight, because the worst is yet to come. The real hair-raising troubles will hit us in just a few months. Warren Buffett's urgent alarm. Renowned billionaire investor Warren Buffett has raised a red flag concerning the U.S. real estate market. He's telling us that there's a big problem on the horizon, comparing it to a brewing storm. When someone as smart as Buffett talks about money matters, people pay attention. By calling it a storm, Buffett paints a picture of something serious and dangerous approaching. Just like a storm gathers strength before it hits, he's saying that there are problems building up in the real estate market. It's a strong warning that we should take seriously and get ready for possible trouble in the housing market. Buffett's message reminds us that the financial world can be tricky, and sometimes problems can become really big. He's telling investors, government leaders, and everyone involved in real estate to be careful and prepared. It's like he's saying, look out, there's a storm coming. And it's a reminder that we need to be cautious and ready for whatever challenges may come our way. The influence of low interest rates on real estate. For the past 15 years, the real estate world has been like a big boat sailing on low interest rate waters. These low interest rates are like a tempting wind, pushing people to buy houses and properties by borrowing a lot of money. It's a bit like when you get a good deal at the store and you want to buy more things because they're cheaper. In this case, low interest rates made buying homes and properties seem like a really good deal. Imagine you want to buy a house or an apartment. If the interest rates are low, it means you can borrow money from a bank without having to pay a lot of extra money as interest. It's like getting a discount on your loan. This made many people think, hey, I can buy a house or property now because the loan doesn't cost too much. So they borrowed a lot of money to buy homes and properties, and this influenced the real estate market a lot. But just like with any good deal, there can be risks. When interest rates start to go up again, which means loans become more expensive, it can make things tricky for people who borrowed a lot of money when rates were low. They might find it hard to pay back the loans. So while low interest rates made buying homes and properties look really attractive, we need to be careful when the wind changes and rates start going up again. A simple example of buying an office building. Let's take a closer look at how buying an office building works using a simple example. Imagine you want to buy an office building, and the price tag on it says $1 million. That's a lot of money. But you don't need to pay the whole $1 million right away. Instead, you can put down some of your own money and borrow the rest from a bank. In this example, you decide to put down $350,000 of your own money. This part of your money is called equity, which is like a down payment. It's what you own right from the start. The rest, which is $650,000, you borrow from the bank. This borrowed money is called a loan. Now, here's where things get interesting. The bank will let you borrow their money, but they don't do it for free. They charge you extra money for letting you use their cash, and that extra money is called interest. The amount of interest you pay depends on something called the interest rate, which is like the cost of borrowing money. In this example, let's say the bank charges you an interest rate of 5%. So each year, you have to pay the bank 5% of the total loan amount as interest. This is kind of like when you pay rent for an apartment, but in this case, you're paying rent on the borrowed money. So if you borrowed $650,000, you'd have to pay the bank $32,500 every year as interest. This interest payment is an important part of your expenses when you own a property, just like paying bills for your home. How profitable your purchase is depends on how much money the building can make and whether it can cover these expenses, including the interest on your loan. Understanding the risks of rising interest rates for property owners. Imagine you own a house or an apartment, and you borrowed money from a bank to buy it. Now the bank lets you borrow their money, but they don't do it for free. They charge you something called interest. This is like a little extra fee for letting you use their cash. The interest rate tells you how much this fee is. Now, let's say you're paying 5% interest on your loan, and you have to pay $5,000 each year as interest. This money comes right out of your pocket. But what if the interest rate goes up? Let's say it jumps to 7%. Now you have to pay $7,000 every year. That's more money you have to spend on your loan, and it can be a problem if you're not prepared. This situation is what happens when interest rates rise. Property owners, just like you, need to pay more money to the bank. If the property doesn't make enough money to cover these higher payments, it can become a financial headache. This is why rising interest rates can be a risk for property owners, and it's essential to plan for these potential increases to avoid financial trouble down the road. When interest rates go up, it can cost property owners more money in loan payments. If the property doesn't make enough money to cover these higher payments, it can lead to financial difficulties. It's like having to pay a bigger rent for your loan, and that's something property owners need to be aware of and ready for. Non-recourse loans in commercial real estate. When we talk about loans for buying big properties like office buildings or apartments, there's something called non-recourse loans. These are loans where things work a bit differently compared to regular loans for buying homes. With a non-recourse loan, if the value of the property falls below the loan amount, the person who owns the property can decide to walk away without facing personal financial problems. Here's a simple example to understand this better. Imagine you bought an apartment building for $10 million, and you borrowed $8 million from a bank. So you put down $2 million of your own money. Now, if the value of the building drops to, let's say, $7 million, it means the property is worth less than what you owe to the bank. If you had a regular loan, you'd still have to pay the bank the full $8 million, even if the building is worth less. But with a non-recourse loan, you have a choice. You can say, I can't afford to pay this loan back because the building is worth less now. And you can walk away. The bank can take the property, but they can't come after your personal money. This is why non-recourse loans can seem like a good deal for people buying big properties. It's like having a safety net in case the property's value drops. However, there's a catch. Because the bank knows they can't go after your personal money, they might charge higher interest rates or have stricter rules for non-recourse loans. So, it's essential to weigh the benefits and drawbacks when deciding whether to go for a non-recourse loan or a regular one. Non-recourse loans in commercial real estate offer a unique advantage. If the property's value falls below the loan amount, the owner can walk away without personal financial consequences. However, these loans can come with higher interest rates or stricter terms to compensate for this advantage. It's crucial for property buyers to understand the implications of non-recourse loans and carefully consider their options when making real estate investments. Economic consequences of property defaults on small businesses. The impact of property defaults caused by rising interest rates extends beyond the real estate market. It can have significant consequences for the overall economy, particularly on small and medium-sized businesses, which are often the engines of local communities. When property owners struggle to make their debt payments due to higher interest rates, it can lead to a chain reaction that affects these businesses in various ways. Small and medium-sized businesses often rely on loans from local banks to grow and hire new employees. However, when banks face increased risks from property defaults, they may become more cautious about lending money. This caution can result in reduced access to credit for small businesses, making it harder for them to expand their operations and hire new workers. As a result, economic growth can slow down, and communities may experience fewer job opportunities. In addition to reduced access to credit, the uncertainty created by property defaults can lead to decreased consumer confidence and spending. When people worry about the stability of the economy, they tend to spend less, which can further dampen economic growth. Therefore, the potential fallout from property defaults, triggered by rising interest rates, has the potential to create a challenging economic environment for small businesses and communities, emphasizing the need for careful monitoring and mitigation strategies. In summary, Warren Buffett's warnings about a looming storm in the U.S. real estate market are starting to materialize. Cheap debt has driven up property values, but rising interest rates and non-recourse loans pose significant risks. We've already seen early defaults, and a substantial amount of debt is due in the next 12 to 24 months. Small regional and community banks, which dominate commercial real estate lending, are most vulnerable. The fallout could affect not only the banking sector, but also small and medium-sized businesses, potentially slowing economic growth. The question remains, who will bear the brunt of these consequences, making it essential for investors to stay informed and prepared for potential market shifts?